Welcome everyone, my name is Marta Gider-Piekarska and I have a pleasure of moderating a discussion between Phil and Kiril. Phil is the core contributor to Spool and Kiril is the core contributor to Bright Union. Welcome both.
Thank you. Thank you.
Thanks, Marta.
So let's start with a bit of a background. So if you can both introduce yourself and then tell me a bit more about what you do, what Bright Union does and what Spool does, and how did you start working together?
Phil, go ahead.
Yeah, sure, I can go ahead. So Spool is permissionless middleware that allows access to DeFi as a whole with very, very specific terms that are then combined essentially into a smart contract we call Spool, and that then subsequently automates and optimizes within the boundaries that these terms create, right? So essentially Spool provides users with a toolbox to build anything they want out of DeFi, out of yield generating DeFi primitives, and then integrate that strategy into whatever product or use case they see fit. So that goes from just personalized finance, right? Managing and automating your own yield farming on your own terms without having to be limited to third-party strategies, all the way to actually building financial services for DeFi as a whole, right? So Spool is not just a product that allows you to build something for yourself or for your friends and family. I think it is also the foundation and the framework for what could be a industry of financial services for DeFi, which I think is the missing piece to mass adoption for DeFi as a whole, because it allows creators to more easily create access to DeFi in a tailored way and in a focused way while targeting a certain user group without having to bridge that entire gap to DeFi. So in that sense, Spool is sort of a middle layer that allows these creators better access, more secure access, and most importantly, more efficient access to then bridge that and funnel this into products for user groups that they might be specialists in identifying. And part of this toolkit is not only automation, I think it's also security and risk management, which I think is one of the most overlooked and underrated parts of DeFi. And part of risk management, I think, should also be good insurance. We've seen a lot of insurance protocols in crypto pop up, and Spool wants to make use of them, but doing so obviously requires a lot of consideration, right? And this is why I've been talking to a lot of experts in that space and a lot of people with great insights in this area. And yeah, Kiril is one of them. So I've regularly corresponded with him to talk about insurance. Where is insurance developing within DeFi? Where is insurance going? And I think he has a unique position to provide an unbiased opinion about that, because we're going to hear more about Bright Union soon, right? But he's in a position to evaluate the evolution of insurance within crypto from sort of a bird's perspective, because that's essentially what Bright does. So I think this is a good segue over to you, Kiril, to talk a little bit about Bright Union.
Thanks for that. Yeah, interesting what you're saying, because we actually, I think we're both, you guys, and we are putting the customer in the center, basically going from the customer, thinking how to make his customer journey easier, right? Because you're tackling the aspect of the investment step, so how people can step into this unknown world of DeFi as soon as easy as possible, and with a little friction as possible. And we are targeting also similar concept, that to give customers basically little bit better understanding of the risks the investments are involved, and also mitigate them. Because what you're saying there, it's a risky business, risky industry. Nobody understands how it works, and especially not many people understand how to protect themselves, right? So we are the Bright Union. We are basically this DeFi insurance aggregator. So we basically provide there one single entry for people to secure their assets, secure their risks in the DeFi, to buy basically the insurance cover, what is called traditionally in the world, and pay the premium and well, sleep tight.
So actually, let's dive into it. What is risk? How do you define risk, Kiril?
Yeah, well, exactly, especially this kind of risk, right? So, well, there are many methodologies in traditional insurance how to calculate the risk. It has some formulas and have some methodologies and stuff, but here there is no answer. Actually, there is no single answer how you can measure the risk in DeFi, whether it's high or low. Well, we know it is high, but how bad it is, and actually, so many smart people already were trying to calculate it somehow. Some propose like maybe the protocol which runs for longest period is the safest. Well, it actually it's true, right, to a certain degree. So the ones who are the big ones who are compound Aave, those who are out there for 2 years, which is nothing. 2 years, I mean, they consider it as like safe. The ones who popped up 2 weeks ago considered risky. Maybe it's true, maybe it's not. So basically the risk is unknown, and we don't have great answer on that. So I don't know. So just do your homework or buy cover, buy insurance.
Yeah, I agree. I think this is also a core reason why we kept risk models open within Spool, right? So I think there's definitely merit to multiple approaches in defining risk in DeFi. Like you said, right? Like you could go simply for time on market and also TVL, based it off the Lindy effect, or you go just a purely quantitative approach in terms of like efficient market hypothesis, high yield equals high risk on average, right? And then there's also a lot of qualitative factors, like is it audited? Are the smart contracts like upgradable? What happened to the admin keys of certain smart contracts, right? All these things. And then once you've evaluated all these things, something like with Badger today happens, right? And they get front end attacked. Like there was an injection, I think. It actually just happened. I just heard about it before we started recording this. Need to look into it, but apparently they got a front end injection that then just routed deposits to, well, a wrong smart contract. I always check the smart contracts, right? Before even then, like I just copy the address, post it in Etherscan and check if it's legit. But who does that? Who does all these things? And I think this is also a problem of branding sometimes. I think a lot of novice DeFi users, they are not even aware of the risks they're taking because we're putting like funny animals and colorful UIs, right? And then in the back end, you're actually risking all of your funds, right? And obviously it's communicated in some disclaimers and something, but the UX suggests this is a fun little game more than a serious financial operation, right? So security and like risk management are very serious topics but for many people, I think they still underestimate the risks they're taking. So yeah, obviously insurance is a great way to do that on top, just like, but I think it doesn't necessarily fully replace risk management on the user end yet. It's just another building block in terms of securing yourself, right?
Yeah, I think you're touching on a very good point that we are trying to make DeFi very approachable and kind of dumbing it down. And then by doing it, we give people the opportunity, like a false sense of security. And because it's all, nobody has ever touched a Bitcoin or an Ether, right? It's all virtual. So for a lot of people, the same way that like spending with a credit card is much easier than spending with cash. because you see the cash going and you don't see, the card just swipes through. Same with DeFi, right? It's just like 2 clicks, okay, it's done, and then it's like, oh, actually, I didn't know where my keys went. I don't know where the money went. Phil, you said risk models.
Yeah.
And what is a risk model?
Well, so in the context of Spool, right, our risk models are essentially a set of scores for supported protocols, for supported yield generators. So risk model providers are essentially asked to provide an up-to-date and comprehensive list of risk scores for the strategies that Spool supports, to then essentially give Spool the input it needs to calculate risk-adjusted yield, which in the end leads to all the decision-making behind rebalancing and allocation to maximize and optimize users' exposure in terms of risk-adjusted yield. The thing is, these risk scores, they will be reached with very different methodologies. As I said before, right, as both Kiril and I said, risk is still a very subjective thing in DeFi because we're lacking a lot of data and we're lacking a lot of many years of experience to truly determine risk. So for now, we have to stick with essentially subjective opinions, and that's why Spool allows open risk models. So to describe it in short words. A risk model provider essentially comes up with an idea of how to define risk. Then they create a method to, they write out a methodology in terms of how they're intending to translate this idea of risk into quantitative risk scores that Spool can work with. And then they demonstrate an ability to get to these risk scores according to their methodology in a way that makes sense, right? And then once they do these 3 steps, they're presenting the risk model to the Spool DAO. And then the Spool DAO has to collectively decide if this risk model is A, a valid approach to risk, in their opinion, and B, if the risk model provider has sufficiently demonstrated that the methodology they're using to determine the risk scores is valid, is consistent, and is consistently executable on their end, right? And only then can a risk model be accepted into the Spool DAO. And what happens then is, once the risk model is included, when users create a spool, which is their set of terms under which they want to engage with DeFi, right? They are asked to select a risk model, which will then be the source of the risk scores that their spool will use to determine their allocation, right? And their rebalancing and so on. And then the user will be presented with the list of DAO curated risk models, and they will be able to read the methodology and find the risk model that most matches their own idea of risk, right? And in this way, Spool gives users another tool to not only be risk managed, but be risk managed in a way where risk is defined the same way or very close to the same way that they would intuitively think about risk and be comfortable in describing risk in DeFi.
Right. So, Kiril, I'm guessing for you that's a pretty interesting feature. Do you plan to provide your own risk model? Because as I understand, anyone can propose a risk model, right, Phil?
Yeah. That's interesting. Exactly. So we are discussing basically a couple of aspects here, right? Because there is what we are also in a similar field basically. Because as you imagine in insurance, in decentralized insurance, the whole idea is that people not only can buy the cover, as they can do with a traditional car insurance, house insurance, stuff like this, but they can also provide the capital to what has been called insurance company before, which was never possible before, because it was always big corporates who are already, basically earning, making money on you as the buyer. The whole idea of decentralized insurance is that there is no company in between. There are people on this side and the people on that side, right? So exactly that what you're saying is that we are also providing the investment model for insurance protocols, right? The protocols we are integrating with, or let's say companies, right? They all have also different conditions how you can provide the capital with them. Basically, again, take the traditional Allianz or AXA or all sort of guys, which you could never put your money in. You can buy again, but you cannot provide capital to. But we are also allowing that. We are basically making the one single investment tool that will allocate your capital on the best condition on a specific risk model over the different insurance companies, right? So yes, and it's also risk model in a way. And yeah, well, I see that it's a potential, of course, to incorporate into their landscape of Spool on that end as well. So that's another side of the possible integrations we can consider.
So what you're saying is, right, that traditional insurances, they're not only insurers, they also manage a lot of capital, right? Because they have large treasuries that need to be ready in case of payouts, right? And then they collect premiums that is also capital for them to be used. And in order to be capital efficient, traditional insurances invest this money, right? So they put this capital to use to also generate some yield on it. In order, obviously because they're a business, right? And increasing capital efficiency allows them to either be more profitable or offer lower premiums on average, right? So you're saying that decentralized insurances, right? They should follow the same model and put their treasuries and for example, also like user funds that are provided through, for example, shield mining or staking. They should put those funds to use as well, so that capital does not just wait for payout, right?
They do, and some of they're growing in TVL. You can see that Nexus currently is staking part of the massive capital they have. They're staking with that Ethereum 2 staking mechanism, and they make the money which go to all the yield coming to the community. Exactly, it's like traditional insurance always been doing pretty much the same, low risk, low return, but still capital efficiency is the key. Breach is also looking into this, and they actually building and about to release it literally in 4 days. So yes, that's capital efficiency. We are actually not trying to solve it for them. We are trying to solve it for the user. So the user doesn't have to go into all these multiple places and compare the conditions, watch where providing your capital is the most efficient. We are tokenizing it in a one single token, and basically provide the strategy to the users. So making it much easier. Well, again, similar to you guys, what you are doing with their DeFi protocols, we are doing what for, but also only for staking in insurance business. Yeah.
So you will probably want to create your Spool. Would you think that you'll be using Spool as a white label or more kind of on Spool UI?
I see it as what we're doing is actually potentially the Spool strategy, right? Because there are multiple strategies Spool will have.
I agree.
And I see that why not to come up with a strategy is insurance. Why not to provide capital to insurance business? And it's a valid business to put money in.
Mm-hmm.
I fully agree, and I haven't thought about this. By the way, guys, this is not scripted or anything, but you make a very valid point. We currently do not, in the first version of Spool, we don't support any stablecoin deposits into insurances as a way to generate yield, but it's a very, very valid way of actually generating yield, right? So I think it would be I think it could be we already are we've been talking to a bunch of protocols that are not included at the launch, but due to the way how Spool works, we can flexibly include new strategies if the DAO curates them and thinks they're valid strategies, right? So I think this could definitely be amongst the first cohort of proposed strategies that we build adapters for and then include into Spool as an option for Spool creators to put money in, right?
I think so.
How would you rate the risk of such strategies, for the user providing capital?
Well, the only basically is traditional is insurance. If you provide money to the insurance, then apart from operational risk, which is of course can happen, this or that can broken. The only risk is the claim, right? The valid claims that the company has to pay, like today's claim of hack of Badger or any other. That's the only typically that's the only case when the insurance company loses money for the rest of the year they're earning premiums, right? So that's but still, I mean, again, it's like going up then a little bit down, going up a little bit down. So that's typical. Yeah.
Come on, Phil.
You actually raised a really good topic there that I wanted to discuss with you as well, and that is, do you see a problem right now for decentralized insurances, especially insuring smart contracts? Because I feel like the outcomes for that are very binary. Either the smart contract is fine, then nothing happens and there's zero payouts, or it gets exploited and then usually it gets drained entirely or almost entirely. And then there's massive payouts for everyone insured in there. And it's highly correlated to each other, right? Because like if you, me, and Marta all deposit into the same smart contract and insure that, for us, it's like our individual insurance, but for the insurance provider, this could also be just one person depositing, right? Because there's like one point of failure. And it's very hard to, I think, like come up with how much of a premium to charge for that. So what do you think?
Yeah, almost impossible. So to yes, you're right. But you know, take the life insurance. It's also quite binary, right? You're either alive or you're not really.
But if I die, then you guys won't die, for example. So it's still just one payout, right?
Right. But yeah, you're right. I mean, if it's extreme case, right? That all of us, three of us, are providing the capital for basically providing coverage for a hack against the hack of Badger, let's say, right?
No, I mean, if we're all in the same smart contract that then gets hacked, so we all put in a certain amount of money. 100 people put money into let's say Cream or something, and then it gets exploited, and all the money is gone. Since we all insured, we all have our claim at the same time. We're all asking the insurance at the same time to pay out our full claim because we all lost all our money and we're all insured at the same insurance, right? So that's a huge black swan event. And I think we've seen in the past that sometimes decentralized insurances have trouble covering that because it's either nothing gets lost or all of it gets lost. So it's either nothing or a big payout at once.
Yeah, but they're all first they're all solvent, meaning they are following the solvency regulation, the European IOPA sort of. So they have always capital to pay out. That's first. You're right, but none of them is having one product only. They have multiple 30, 50 products, right? So meaning that all the capital is spread over. So in order to them really to drain the pool of all the money, all the capital, all 50 must be hacked and fully hacked. And so I mean, you always never can go to zero. However, you're right that it's quite substantial if like for instance, Anchor is now top one popular cover to buy. Basically, most of insurance companies, insurance protocols, they sold out. So Anchor is the huge exposure of capital. It's basically if that guy is hacked, then there are massive claims everywhere. And yeah, but they all have balanced. I mean, it's maybe 3 to 5% of all their capital is allocated for protecting that specific protocol. So it's still manageable, let's say. And the way how everyone addresses it, premiums are basically quite expensive. If you compare, if you go to Bright Union app and take any protocol and you see the covers, how much the covers cost, they're quite expensive. They are around 2 to 3% of your covered capital. So in order to insure basically $100, you have to pay $3, which is kind of doesn't sound like expensive. However, it is very, but it is expensive. Yes, in traditional insurance, it is considered as expensive. It's like you're paying your house, whatever, 100,000, and you have to pay, well, 3,000 premium just for 1 year. That's a lot.
Do you think that these high premiums kind of like are a hindrance for adoption for these insurances because a lot of people are cheaping out on it or think it eats into their yield too much?
Well, I don't think that's really the big issue now because typical DeFi protocol offering APY is 20, 30, 50, 100. right? Then 3% is kind of nothing. It's high risk, high return actually for most of them. However, if you take Aave, for instance, which offers like 5% or whatever stable return, then 2.5 will be like already half of your yield. Right?
Yeah,
it's kind of expensive. Then you need to find out some better. Then maybe you need to decrease the price because it's like safe haven. Maybe it is.
and do you think like, because that's kind of my theory, right? My theory and a thought behind Spool is as well that well, premiums obviously are closely tied with the risk, because an insurance has to calculate what's the risk of me actually paying out this claim, and that's a core driver of the premiums charge. So do you think if like what do you think about something like portfolio insurance that is much more diversified, and then you don't have this risk of the, like, if there's a claim, it's not going to be 100% of the portfolio. It's going to be a small part of the portfolio. Let's say we're spread out evenly across 20 different smart contracts, and then we're insuring that kind of portfolio at once. Do you think this sort of risk reduction could impact the premiums positively compared to just putting everything in one basket and then insuring that?
Yeah, I'm not sure that will be really, much cheaper if indeed in your portfolio contains, if you invested in 20 different protocols, right, and you insure your portfolio as a whole. I'm not sure that it will be much cheaper. It definitely will be much more from user perspective, user experience, that would be much more efficient, right? I mean, it's insurance as you go. That's another next hot topic. I think many players in the market will go into, like streaming your insurance, or streaming the premiums for your insurance, meaning that you don't have to buy anything, right? It's given. So it's like MasterCard or someone, where whatever you pay with that, it's already, your spendings are already insured. So basically you're already safe. Or as an example, maybe, well, not the best example, like flight or your luggage. Well, it's not really embedded, but you can buy it extra. But yeah, it's nice for user experience for sure. But actually, we are offering this. We are having quite a lot of requests from institutional and family offices players who are, yeah, they want us just to help them to build up the portfolio of covers, right? Basically insure, let's say 70, 50, 70, 80% of their active portfolio. They manage in big capital, of course, and they don't know
in
how.
DeFi or?
Yeah, in DeFi, yes, in DeFi. Yeah, and they already assume that certain percent of their portfolio will be hacked, 2, 3, 4%, let's say. Then they are really, well, they say, well, can you help us guys to buy the products for a decent price on decent places, and just help us to manage that.
So they're already diversifying across multiple protocols, and then they're expecting like one or two to in the end get exploited. Yeah.
I think, yeah, there's something that I really like about what both Bright Union and Spool does, which is really bringing opportunities to traditional finance to dip their toes into the DeFi space without the dramatic risk of we're just gonna, buy and hold this crypto or invest in this protocol and pray for the best. Because with what Spool does with the automated diversification of your portfolio, with Bright Union's opportunities to ensure that and to kind of cover part of the portfolio, I think there is a lot of good stuff that is happening here to merge the two worlds. Because maybe I'm very traditional. I don't think that TradFi will go away and we'll just have DeFi. So we need to build bridges. What's your perspective kind of on 2022? How will things shape up? Do you think that adoption of DeFi into TradFi is something that will happen next year, or do we need more time?
I can go ahead if you want, Kiril. So I think what DeFi is doing really well. First of all, I think we're growing as a whole very nicely in terms of the options we have in several fields. I think the prime leaders in terms of generating yield are right now still lending protocols and AMMs. I think those are the two core. AMMs are automated market makers, just for the video. I think those are the two core ones. There's more things that I see coming up, more strategies that I think are coming up. Like Kiril mentioned, I think being a cover provider and earning yield while providing coverage for insurances is inherently yield generating, because insurance math makes it like insurances generally win, right, on average, because otherwise they wouldn't be profitable businesses. And decentralized insurances enable you to essentially be a part of that kind of business, right? So that's another strategy. There's more options coming up, but what's lacking in DeFi right now is a infrastructure for financial services, right? So currently, most people interacting in DeFi have to go directly to the source. I mean, there's some yield aggregators and optimizers, but it's all very, very closed-ended in terms of when you go to yield optimizers and yield aggregators, you're following sort of a predefined strategy that then automates your portfolio to a certain degree, right? But you're kind of locked into a strategy that the yield optimizer or aggregator presents to you. So what's missing, in my opinion, is an infrastructure where DeFi becomes more accessible and usable without making it a full-time job and without providing massive resources to it, that simply help both individuals and also professional users to sort of have an overview over DeFi, still have full agency in terms of what their choices are, what their risk tolerance is, what their targeted risk-adjusted yield is, but then also having to not go to all of these dApps and websites individually, connect their wallet, approve, deposit, compound manually, and all of that stuff, right? So, and that's what a financial services industry or our infrastructure for DeFi would solve, right? And that's also, obviously, I'm going there because that's the core thesis behind what Spool is trying to do, right? We're trying to establish this kind of infrastructure that allows that Spool itself isn't the financial services industry, but we're trying to make it basically the framework within this industry can be built, because obviously when it comes to traditional adoption, you have to suddenly start thinking about regulation. You're talking about real world businesses tapping into this, who are then watched by regulators. But then we live in a global world with many different countries and different regulations. And especially when it comes to crypto regulations, a lot of things are still in flux and changing very quickly. So bridging this whole gap and going from the base level yield generators towards a very specific user base in a specific country is a very large jump to make all at once. So what we think, or what the thesis is that I have, is that we need to provide an infrastructure at the point where we have the smallest common denominator, which is where like everything can like sort of come together in terms of what yield generators can I pick, risk models, automation, all of these things. Those are something that I think any business or any application that tries to bridge DeFi to the real world, those are tools that all of them will need, right? And then we can like bring all of that together in one ecosystem and one platform, and then give these creators the tools from there to create the products that are suitable for their regulation, for their use case, for their user base, right? And then we suddenly make this large jump a much smaller jump, because we kind of have this little island in the middle that they can land on, go from there, create from there, and then act from there, and focus really on nailing their use case, marketing to a user base, or being compliant with very specific regulations, right? So I think if we can create this sort of infrastructure, and then we can help the creation of a financial sort of, or a DeFi financial services industry then I think like adoption will go much smoother. If that's going to be in 2022, I kind of doubt it, but it's going to be a process, right? So if we can even get a start in 2022, I'm going to be very happy about that. But yeah, it's going to be a long process, and that's not going to be a process that's going to be done even in 5 years, maybe not even in 10 years, but we're going to be much further than we are now. That's for sure. That's my take. Pretty long. Kiril, what do you think?
Yeah, I agree. I mean, you see, the capital is started, the serious capital started to flow in. So what's been just a year ago in saying never in crypto, banks and etc. Now they're saying, well, how can we try, right? You're seeing the futures are appearing. You see ETFs are already being discussed, and the big players out there. We see ING Bank stepping in, JP Morgan, Barclays. They all starting to a little bit step by step starting to find opportunity, low risk, low return, exactly. So specific strategy, specific risk tolerance, what you guys already have. So I mean, it's getting there, and well, once they put it in, they will come to us and say, well, how we can reduce our risk, right? So I mean, we're in the right spot. Yeah, it's no doubt. When yeah, it's a process indeed. Next year will be bigger. Maybe then it will slow down a little. The risks are insane there. I mean, it's all still the bull market is really pushing it, right? Adoption is coming because of this insane bull market, which is on Colossus legs, basically clay legs, let's say, because there are a lot of NFTs, gaming, all the noise around, etc. So. But I think I see three major pillars in the traditional business models that are seriously disrupted by blockchain tech. That's the DEXs, so exchanges, right? The ones which are been traditional exchanges where you could never be listed so easily as nowadays in crypto. So it's DEXs, it's lending, borrowing, which is traditional banking. So the second one. And the third one, I see the decentralized insurance. So it's insurance business without the business. And those three, and the rest, the most of the rest is built out of nothing. It's inflationary models, farming, staking, without the business model. So I think we are on the right path.
Yeah.
So you're saying that 2022 will be year of maturing and growing up a bit.
You would believe it's like this, but actually it's a lot of pain, and then.
I think what you're saying is that fundamental value is often not the same thing as market value, and in crypto, I think momentum is such a big aspect, and if something gains momentum, then because it's like kind of an open source world, and it's a world where you can move very quickly, then you get flooded with a lot of let's say opportunistic projects that are trying to grab onto a certain momentum, and that kind of overshadows a lot of the fundamental development that's going on in the background that could be much more meaningful for the long-term future, right? So when you see I think play to earn is actually, GameFi is going to be very interesting in some ways, but then I also see a lot of games out there with $1 billion fully diluted valuations that don't even have like anything, right? There is no game there yet, right? And I think this is also what you mean with like clay legs, right? Because these things they go up very quickly, but they depend a lot on speculation. And I think one big problem that DeFi has, where we also have to kind of look in the mirror a bit as people that are trying to push and advance DeFi. We need to bring it to the people because they're not going to come on their own, at least not in masses. And I think a big thing of games being so successful and speaking to so many people is that they're very approachable because they're a concept they already know, right? And it's something that they can approach. And I think 10 years ago, right, when I was still like a teenager, it was my dream to earn money while playing games, right? Because that's what I like to do. And now this dream like is being presented to a lot of people, and it really resonates with them. And I think in comparison, finance and handling your finances is a lot less sexy to a lot of people, because it's something that's associated with going to the bank, having an appointment with an accountant and things like that, which is something people don't really connect to with enjoyment. And then also our statement of be your own bank, right, which is a core crypto mantra. I think it's something that maybe a lot of people, they don't want to be their own bank. They want to have their finances managed, and they want to have a bank teller or someone tell them, this is what I want to, this is where your money is safe, and this is where it's like efficient. And then they want to go on with their life. But we all realize that the traditional system is kind of broken, and we're kind of trying to break it and disrupt it. But I don't think we can just take away like that user experience and just say, okay, do it on your own. We need to replace it with something better, right? And I think this is how we bring DeFi ultimately to the people and actually get people excited about it. What do you think?
Yeah, exactly. Yeah, fully agree. Yes.
Awesome. Well, thank you both. This was very interesting for me, and I'm sure for everyone else as well. I'm really looking forward to seeing your work and your collaboration. And yeah, have a great afternoon.
Yeah.
Lots to talk about. Thanks, Kiril, for your time, and thanks, Marta.
Thanks, guys.
Chat soon.
Yeah.
Bye, everyone.
Bye-bye.